Welcome to the Stock Sale Flyer. My name is Aaron, and today we're going to be discussing the Kraft Heinz company, which I think is kind of great because we're basically launching this show by discussing a cheese and ketchup company, which I think really, in a lot of ways, kind of speaks to what we're trying to do here with this channel. In a world where the S&P 500 has really been just almost straight up since maybe the fall until the last week or so when we've seen finally a pullback. We're looking for ways to find value in a stock market that I would consider to be still very overvalued. And that's really a big part of the goal here and what I'm doing. Now, none of this is financial advice because I'm not a financial advisor. However, I've spent a good amount of time trying to learn value investing, learn how to value different equities. And so my goal here is to really share some of that with you and maybe start some conversations. So if you hear anything that you'd like to engage about in terms of more conversation or anything you'd like for me to go into more detail on, please drop a comment, let me know, and I'd be happy to interact with you more on any of these topics. So let's go ahead and get into it. I'm going to go through some history of the company, and we're going to take a look at why I think this stock might be on sale. And ultimately, after going through some 10K highlights, talking about some recent developments, I'm also going to give you my DCF valuation for the company and really go down through that with you piece by piece and really talk about how I arrived at what I consider to be a fair value for Kraft Heinz. So the first thing I think that I really like to do whenever I'm evaluating a company like Kraft Heinz, which I do have a position in, by the way, I am invested in this company, is I like to understand how does this business make money. And for Kraft Heinz, that's pretty straightforward, I think, for a lot of us. They're a food company, right? So they have a lot of brands that you see in your grocery stores on a regular basis. So Kraft, Heinz, Oscar Mayer, Ore-Ida potatoes, Classico sauces. You see Velveeta, Philadelphia cream cheese, Lunchables. So this is a company, I drink Maxwell House coffee almost every day. This is a company that they're a consumer staple company. But when you compare them to some other consumer staple companies in the market, I think their valuation is lower than a lot of the other big consumer staples companies that are out there. And you look at where this company's stock price has really gone over the past, back to 2018, 2017 even, by the looks of it. It's just gone down. Not long after the merger, you've seen a big move to the downside. And then it's just been consolidating, going sideways for really the past several years. And I think that there are some things going on with the company that are going to lead to this consolidation really breaking out in the not too distant future. Could be wrong about that. It's just my opinion, but I do think that there's a pretty good chance that this company has brighter days ahead and that this is one of those companies that really has just had some short-term problems. So if we look at kind of how we got here, obviously these companies used to be separate companies. Kraft and Heinz were separate companies. And in 2013, Berkshire Hathaway and 3G Capital bought the H.J. Heinz company. And then a couple years later, Heinz purchased Kraft Foods, and the two companies were then merged together. So in interviews not long afterward, I should say in an interview that I saw, I don't have the date of that, but this article is from 2019. Warren Buffett, in the interview that I saw, said that they had overpaid for Kraft. He said, we didn't overpay for Heinz, but we overpaid for Kraft. And I think that that is a part of what has led to some of the issues for this company in the short term. But I still think that it's a company that is going to cash flow. People are going to continue to buy their products. I know that they do face some competition from private label brand names and things like that, but I think they're going to continue to sell their products and do just fine. And so I think, and part of what my thesis is going to be today for this is that as the balance sheet continues to get healthier, this company is really going to finally break out of this consolidation that it's been in for several years, and hopefully, see brighter days ahead. In 2023, Kraft Heinz agreed to a $450 million settlement with some of their shareholders. So this is a company that they have had some other issues, but I do think that the balance sheet is one of the biggest factors. If we go back and look at the past years in the balance sheet, shout out to QuickFS. This is a fantastic resource that I use all the time. If you look at the Goodwill column, which is, or the Goodwill row in this balance sheet, Goodwill is something that when a business buys another business and they pay a premium for that business, that premium has to be accounted for somewhere on the balance sheet. And so that is accounted for under Goodwill. And you can also see in 2015, we look over here, there's a ton of intangible assets added around the merger and a ton of goodwill added to the balance sheet around the time of the merger. And this can cause some problems for businesses when they overpay for companies like Warren Buffett says happened with Kraft. You also see, when you go back in the history of the balance sheet, a ton of debt added to the balance sheet. A lot of long-term debt was added in 2015. And so when we see this weight added to their balance sheet, and then we look at how it's progressed since then, we can see that things have started to get healthier. And I think that's part of the turnaround story for Kraft, is that as this debt gets paid down, and we see it has been, we go back to 2015 and we go forward, they've paid down about a third of that long-term debt. And we can see that about a quarter, actually more than a quarter of the goodwill has rolled off the balance sheet, and almost a third of the intangible assets have rolled off the balance sheet as well. So this it might still affect their earnings, but they will hopefully be getting to a place where they don't have to take so many goodwill impairments and impairments for other intangible assets, so that they don't have things happen like what happened back in 2019 when they had over a $15 billion write-down, really because these assets on their balance sheet, these brand names on their balance sheet, were not living up to their carrying weight. So, when businesses buy other businesses and they overpay for those businesses, and then they don't produce well enough to carry that valuation, the company has to write that down, and it affects their earnings. So hopefully they're moving into healthier places with this. If we look at their 10K from this past year, I just went through and highlighted some things that I found interesting. So if we take a look at the impairment losses, it says that our results of operations reflect goodwill impairment losses of $510 million and intangible asset impairment losses of $152 million in 2023. compared to Goodwill Impairment losses of $444 million, intangible asset impairment losses of $469 million, and net property, plant, and equipment asset impairment losses of $86 million in 2022. So the total write-down in 2023 was less than it was in 2022. And if you go back and you look at some of those older income statements from prior years, you can see that it appears the number of write-downs they're having to take that are affecting their earnings reports are getting smaller. So that's a good thing. That's really what we're looking for here, is a turnaround story in terms of the balance sheet getting healthier. And then also where's the growth in the future going to come from? And that gets to part of this next piece. So small net sales increase, and you'd like to see more sales growth, more revenue growth overall. But one of the things that I really highlighted was that a lot of the growth was coming from the international sales side. So if you look at the international net sales, North American sales actually declined slightly, but they saw a 6% increase in international sales. And so I think that one of the growth drivers for Kraft moving forward is going to be moving more into international markets. So their acquisitions and divestitures, we can see some evidence of this expansion overseas when we look at where they are looking at acquiring companies. So they purchased, it said in the first quarter of 2022, they acquired 85% of the shares of Just Spices. It's a German company, and they do spice blends. And they later purchased another 5% of the company. So they now own 90% of the controlling interests in Just Spices. What I think is interesting about this is it's not just, we can go look at this company's website here for a second. So this is an article about it, about the acquisition, and then we can go check out this company's website. So this is where it's direct to consumer. It's probably a higher margin business than some of the in-store stuff that they do. So my hope is that this is a good acquisition, that they didn't pay too much for, and that this won't result in more goodwill impairment, but will actually help them grow the company and boost their revenue. So in the second quarter of 2022, they also acquired a company called Hemmer from Brazil, which is actually over 100 years old, this company. And they connect this to their taste elevation strategy for growth. Kraft breaks their different products into different categories, and taste elevation is one of them. So again, moving more into Brazil, hopefully with this acquisition of Hemmer, hopefully, this was another positive acquisition that will result in growth for the company and not goodwill impairments. So that's something that I'll be keeping an eye on moving forward with this investment. Another acquisition they made back in 2019, I believe, was Primal Kitchen. And this is a company that focuses on different dipping sauces, and they really focus on higher quality ingredients, or at least that's the market they're going for. Trying to get more into that business of giving people more quality foods, because I think we can all see that kind of becoming more popular these days. People are looking for healthier alternatives to some of the things that maybe, if you're like a millennial like me, maybe you grew up in the 90s with some not so healthy things and you're looking to move away from some of that. So maybe this is a move in that direction. One thing that I'm interested in seeing how it works out, they did sell their planters business to Hormel back in 2021. And that one, I'm not sure how I really felt about that. I'm hoping, I've seen places say, or I've seen it noted somewhere that it would be positive for both businesses, for Hormel and Kraft Heinz. So I'm hoping that's the case, but I guess we'll have to wait and see how that affects them in the long run. It's only been a few years since that sale. So those are some of the acquisitions and divestitures. Overall, I hope that it helps them support a growth strategy of moving more into overseas markets, and really expanding out beyond the United States. And I think you're seeing that reflected in the sales increases. I hope that you see the 6% growth in sales in the last fiscal year. And so hopefully that's evidence of that. This was a note about capital expenditures, which is going to affect their free cash flow. So I highlighted that. They expect them to be $1.1 billion in 2023. Not really that far off from the prior couple of years. So to me, that's not a major thing. And this highlight makes it appear that they will continue to, which I would expect anyway, but they will continue to repurchase shares. So this is a company that you hope they're doing share buybacks. They issue dividends. So you're going to be getting those dividend benefits along the way if you own this company, but also the share buyback program, allowing you to own more of the company over time. Now, I went through this section because this got to Goodwill Impairment, and I said that the balance sheet was one of the big issues for this company and has been one of the big issues for this company, I think, for the past several years that has suppressed the share price. So one of the things that we want to look for if we think the company is going to do better is what are the carrying weights for these businesses looking like? And are they going to have to do more significant write-downs on these businesses? Or does it look like this is all getting healthier and this isn't going to affect their earnings as much in the future? So you could pause the video or get the 10K and read through all this if you wanted to, but I did put a circle around this note where it said our brands that have less than 5% excess fair value over a carrying amount as of the 2023 annual impairment test are considered at a heightened risk of future impairments and include our Kraft, Velveeta, Maxwell House, Cool Whip, and Jet Puffed brands, which had an aggregate carrying amount of $13.5 billion. So it almost seems like those businesses might be taking, or those sections of the business might be taking write-downs in the future. But where so much of that goodwill has come off the balance sheet already, I think it will get better regardless. They may face those write-downs. I'm not sure if these businesses or these parts of the business aren't carrying their weight because they're still significantly overvalued, or if they're just facing more pressure from private label brands like ones from Costco and Walmart and things like that. But that is something that I'll be keeping an eye on as things go forward. I highlighted the long-term growth rates that they used for their impairment testing to see if these businesses were carrying their weight, or these labels were carrying their weight within the portfolio of brands, because I used 1.5% as my long-term growth rates for my DCF, which is actually lower than I would usually use, but I like to be conservative in my estimates, and so looking at this, it seemed like that would be a fair percentage to use as a long-term growth rate. We'll get back to that in a minute when we look at DCF valuation. Thought this was worth pointing out. Goodwill impairment losses and intangible asset impairment losses. You can see back to 2021 on this, how those impairment losses overall have, declined. And so this is what I mean. I think we are seeing a healthier balance sheet, and I think it will continue to have less of an effect. So let's take a look at the valuation. So for total revenue, you can see the total sales here going back the last 4 years, and you can see how there hasn't been a lot of revenue growth. There also not really expected to have a ton of revenue growth over the next couple fiscal years. I used analyst estimates for 2024 and 2025 when I did this calculation. And then for the 3 years after, I took the average of 2021 through the 2025 estimate and just carried that forward for the next 3 years. I actually think that this is a sort of positive, though, because if they have more growth in revenue, say they do grow the business more internationally, and that leads to higher sales numbers, then that actually leads to more upside. When we look at their net income margins, you can see the balance sheet improving reflected there in the last two fiscal years net income margins. And it appears analysts do expect their net income margins to improve in 2024 and 2025 as well, probably because of that improving balance sheet, which is the same thing that I've been looking at. To calculate these numbers, I found GAAP earnings estimates for earnings per share on ticker and multiplied by the number of shares outstanding. I'm not sure if the analysts factored buybacks into their estimates or not, but I did not do that. I have 14% going forward for the following 3 years, assuming that 2025 number becomes more of a norm for them. And then for free cash flow to net income, I assumed 100% going forward. I think that is something they could do that would be healthy for them. I think that is a reasonable expectation for this business. My perpetual growth rate, I went with 1.5%, considering the long-term growth rates that Kraft uses did use for their impairment testing. Looking at those numbers that they used, I figured that seemed like a reasonable assumption. Again, that's a lower perpetual growth rate than I would normally use. But again, if they exceed that, that's only going to make this valuation more conservative, and it only means that there's potentially more upside here. Just my opinion. In terms of the weighted average cost of capital calculation, you can see that down here. This is what I used for my discount rate. For if you're new to DCF valuations, the reason why you have to have a discount rate is because $1 today is worth more than $1 in the future. So you look at what are the future cash flows of the business, what are the future free cash flows of the business, and then you discount those back to today's to today. And to do that, you need a discount rate. Now, some people use a weighted average cost of capital. Some people use the return of what they think the market as a whole is. Some people even just use what they consider to be a risk-free rate, like a U.S. Treasury bond number. I like to use the weighted average cost of capital. I think that is a good number to use. Now, I do factor in, so for my risk-free rate that goes into calculating the weighted average cost of capital, I did use the 10-year bond rate as my risk-free rate. And for the beta, I believe this is a 5-year average of 0.67. So betas basically account for the volatility of the business's stock. And so if you have a business whose stock is more volatile than the market, you'll have a higher beta because you need to have a higher return to justify that volatility. And then for the return to the market, I use 10%. You can see that when you use these numbers, you get a fair value of the equity of $57.58. And I also like to look at the 2028 net income number and look at what would the price to earnings at different levels be if you were to buy the stock in the future, let's say in 2028 in this case. This would be with no change in shares outstanding. If you bought it with a PE of 15, if that was their net income in 2028, you would pay $48.59 a share. If you were to buy it with a PE of 20, you would pay $64.79 a share. And if you were to buy it with a PE of 25, you would pay $80.99 a share. And I do think that if the business keeps getting healthier, the balance sheet gets healthier, that higher multiples are possible. So you can see some higher multiples in some other consumer staples businesses. And so I think part of the reason why Kraft is at the multiple that it is because of some of the recent problems they've had with things like their balance sheet. So I definitely think some multiple expansion there is a possibility. Now, to be honest with you, when I calculated this, I wasn't entirely confident in this. I wondered if some of these analyst estimates were a little bit too high. And so I did do a more conservative case just to get an idea. And you can see this would be with a lower revenue growth rate and net income margins of just 10% going out into the next 5 years. And you can see how that would affect the fair value of the equity and also the numbers at different multiples in 2028 if this assumption were to hold true. Which, with this assumption, their net income is actually lower in 2028 than it was in 2023. So, and it's still, it's still, if you look at the fair value, is above what it closed at on Friday. So granted, this would be based on their free cash flows, but I just find it interesting. You give more conservative numbers and you still get a fair value, or I get a fair value above what it's currently trading at. So again, this is not financial advice. It's just my opinion. I can, just in case I missed anything with this valuation, the more conservative one, I can show you those numbers for weighted average cost of capital, although I believe it's the same. If you want to drop a comment, let me know if you agree with this valuation, disagree with what you're seeing here. I would welcome feedback. I'm hoping to have some ongoing conversations with other people who are interested in value investing. So I really appreciate your time today, and I hope you consider giving me a like, subscribing, and maybe clicking the bell so I can see you in future videos. Thank you, and have a great rest of your day.